Hello, good morning, everyone. You are welcome to this webinar. I want to appreciate you all. Please just give us 2 minutes so that we can quickly assess 2 or more people and ascertain that more people join this meeting, because the number of people that registered were almost 50. And we have just 11 participants here right now. So we are expecting the others to join. So please just give us about 3 or 5 minutes. We will start the meeting. Thank you, everybody. Once again, I want to welcome you all to this webinar. And starting this webinar right now, I have some people that will be moderating this webinar with me. And this webinar is tagged Understanding the Commodity Markets in conjunction with Afex Commodity Exchange. And we have some staff of Afex Commodity Exchange that will be here with us, giving us how the commodity market works. So I would like to introduce one of our speakers today, that is Michael Martins. Michael Martins, if you are hearing me, please, can you please wave your hand or please speak so that the audience can hear you? Michael
Hi,
Martins.
everyone. Good morning. Lovely to be
Thank
here.
you, Michael Martins. And I also have with me here on this platform, Sarah Dogo. And she's also going to be moderating with Michael Martins from Afex Commodity Market. Please, Sarah, please, can you please indicate that you are here with us?
Good morning, everyone.
Okay, thank you. Yeah. Then my own name is Olayemi David. I am also from Otto Steven Investment Management, and I have with me Mayowa Mulitoko, who will also be moderating with me. Mayowa, can you please and then let us identify you.
Good morning, everyone. Good morning, everyone.
Thank you, Mayowa. So I would like to invite Michael to share his screen while we start this webinar now. I would like you to please bring out your pen, your paper, and write down, as this webinar is going on, some questions that you might have concerning commodity market. Michael is going to give us what commodity markets is all about, and is going to tell us how you can trade commodity market even at your own time. So I would like to invite Michael now to speak with us on the commodity markets. Michael, you are welcome.
Hi, David. Thank you very much. So I'm currently trying to share my screen. Can you give me access to do so? Thank you.
Okay. Just a minute, Michael. Okay, I've made Zara co-host and as well as you. You can share your screen now. Please, Michael, we also appreciate it if you can.
All right.
Put on your
Good
videos
morning, David. Can you please confirm
so
that
that
you can
people
see
can
my
see you.
Yeah, I can see your screen. Oh.
All right, then. Thank you, everyone. Thank you for joining this webinar. It is much appreciated. So like David had mentioned earlier, my name is Michael Martins, and I work in the strategy and corporate finance team at Afex Commodities Exchange. Alongside me today, I also have my colleague, Zara Dogo, who works in institutional sales. And with her, we also have Sam Uko, who is the head of institutional sales. So like David mentioned a couple of minutes ago, we will basically just be explaining to you the modalities of the commodities market. So essentially, what is a commodity? What is a commodity market? The different types of commodity markets that we have, how you can engage, the different types of commodity markets that are available. And lastly, we'll just give you also an overview with regards to what we do here at Afex Commodities Exchange, the type of products that we have. And then we'll end that with showing you just a brief demonstration of what our COMEX, which is trading app, what it looks like. So just before I continue, can anyone please confirm in the audience now that they can hear me quite clearly?
Yes, I can hear you. Yes.
Hi, David. Can you please confirm that you can hear me clearly?
Why can't I hear you? Increase your volume. Do it at the volume.
David, can you please confirm that you can hear me?
Michael.
Yes, you can hear me, correct?
Yeah, I can hear you. Let's speak on.
Okay, fantastic. All right, so essentially the first thing we'll be going through is what exactly is a commodity, the first thing we need to understand is that commodities are goods of uniform quality and value that is delivered to the market by multiple suppliers. And so the first thing you need to understand that what a commodity is. So like the definition here says, it says commodities are goods of uniform quality and value that is delivered to the market by multiple suppliers. And you have to understand that the idea of uniform quality and also uniform value is a quality that is intrinsic to commodities, right? Um, is a quality that is intrinsic to commodities, right? And what you would notice that is that we see and utilize commodities such as coffee, milk, sugar, or gas every single day of our lives, right? So when commodities are traded on an exchange, there are certain minimum quality and elemental standards that must be met. These standards are referred to as basis grade, right? So with regards to commodities, in this case, especially agricultural commodities, they're usually standards and grades that have to be adhered to, right? But the most important thing for us to note here is that commodities are goods of uniform quality and also uniform value that is delivered to the market by multiple suppliers. And what that tells you off the bat is that in any given commodities market, you're going to have multiple buyers and also have multiple sellers. There are essentially two types of commodities. On the first hand, we have hard commodities, which are essentially metals like platinum, gold, silver. I'm pretty sure some of you either have a gold watch or chain on currently. That's a commodity. Or you also have energy, which is crude oil, and then also natural gas. For some of us that have cars here, I know that we've had to buy crude oil at some point in time over the past couple of weeks at higher prices. So that's an example of another hard commodity. On the soft commodity side, we have agriculture, which is essentially maize, soybean, paddy rice, wheat, which are majorly what we trade on the exchange here. And then you also have livestock, which can include livestock, pork bellies, eyes, and what have you. In terms of defining, the different types of commodities that we have, hard commodities in most cases, right, are mined out of the ground or otherwise extracted from another natural resource, right? So when you define hard commodities, they usually come out of the ground in terms of you having to mine them or you having to extract them from one natural resource or the other. In terms of soft commodity, they're usually grown over a large expanse or large acre of land, or they're usually grown over a large acre of land. And like I mentioned earlier, these are most likely, agriculture, and then you also have livestock. So from moving from an understanding of commodities of having a uniform value and then uniform quality to understanding the different types of commodities that we had, which are hard and soft, it's that we can then move forward to what exactly are commodity markets. A commodity market is simply a medium for connecting buyers and sellers. It is literally that simple. Regardless of the type of commodity market that you have, its major purpose is to act as an intermediary between people who want to buy commodities and people who want to sell commodities. That's essentially what a commodity market is. And there's broadly two types of commodities market that you can have. You can either have a formal organized commodity market, or you can have a physical location with central trading places or virtual, without a specific trading station. An example of a formal commodities market is what you have on Afex Commodities Exchange, is what you have let's say on the Chicago Mercantile Exchange, that is in the United States, or what you have on the Multi Commodities Exchange in India. Those are examples of formal markets. And what essentially makes them formal is the fact that every single interaction there is structured and it's standardized, right? You can't just go there and willy-nilly just buy any sort of quantity or quality that you want. Every single thing with regards to the interaction of the different players in that market is organized and it is formal. With regards to the informal market or having a physical location, an example of that would be the Dawanu market that we have in Kano State, where you can essentially just go at any given point during the market day, in this case, and then just go and buy that commodity. With regards to that market, it's completely informal. There's no structure. There's very little structure to it, I should say. And there's very little in the way of standardization. So you can essentially buy commodities from, grade 1 to grade 2 to grade 3, and you can essentially buy from any and every person that is available to sell to you in that market. The market is not organized in the traditional, or is not formal rather, in the traditional sense, but by which commodity exchanges are. So the different types of commodity markets that we also have, aside from the broad definition of formal and informal, is we have, first of all, OTC market. We have the OTC market, we have the exchange traded market, rather, which is a financial contract between parties. The exchange traded market, like I said, is largely the exchange traded market is largely for more, the interaction between the players in that space. It is structured, right? And usually, what is traded back and forth is not the physical commodity itself. It is usually contracts that are backed by that physical commodity, right? Which is why the definition here for the exchange traded commodity market is it's essentially a financial contract between parties. That is, an exchange traded commodity market facilitates the exchange of contracts, right, between one party to the other. And the other type of commodity market, you have the OTC or the cash market, which is also called the spot market in other definition. And this type of market is essentially cash to hand. You go to the market today, you go with your money or your capital and you buy that commodity and it's delivered to you instantly, right? There is no quote unquote contract being transferred from one person to the other. It is usually 90% of the time, if not all the time, an exchange of cash for commodity or commodity for cash. And all those transactions are settled on that particular day. With regards to the exchange traded commodities market, you can then have four different types of contracts that you can trade on those type of formal commodity exchanges or exchange traded markets. So the first one, you have futures, you have swaps, you have options, and then you also have forwards. We will probably go into a whole lot more detail with regards to the types of contracts that you can trade on the exchange traded contract. But broadly speaking, these are the two types of commodity markets that we have. When you look all over the world, in addition to the ones that currently exist in West Africa, which would be the Afex Commodities Exchange, and also the Ghana Commodities Exchange, you also have some exchange in East Africa, which would entail, in East Africa, which where you have Rwanda and then also have Kenya. In Rwanda, you have the East African Exchange, and then in Kenya, you have the Nairobi Coffee Exchange. In Europe, or rather in America, you also have the U.S. Futures Exchange, and then, like I mentioned earlier, you also have the Chicago Mercantile Exchange. You also have, in Europe. In Europe, you then have, in Germany, you have the European Energy Exchange, United Kingdom. All of this is just to show that the exchange infrastructure itself is pivotal, right, to the exchange of commodities for capital, regardless of whether or not it's an OTC market or an exchange traded market, right? So when you look, hardly would you find a country that doesn't have a commodity exchange, right? And that tells you the importance of these types of commodity exchanges, or maybe by extension, commodities market, all around the world. In terms of the participants that you have on the commodities market, right? The first type of participant that you have in a commodity market is an edger, right? The reason why this guy wants to edge, right? Let me broadly define what edging is. So edging is an investment strategy used for minimizing risk. Generally, edgers are producers or consumers who want to transfer price risk onto the market. Now, it's literally it's as simple as straightforward, right? Now, let's take a moment and let's backtrack a bit. Remember, I told you that there are broadly two different types of market. The first one is the OTC cash market, which is where you take your cash to the market and you buy your commodities on day one, and that commodity gets settled on day one. All that entire transaction gets settled on day one. However, in the exchange, you can then begin to have different types of participants, like edgers in the market. And what they're trying to do is this. So take, for example, for a processor who uses maize in his production process, he doesn't know what the price of maize is going to do over the course of an entire trading season, but he needs to edge his position in that market at any given point in time. So what he's going to do is he's going to probably go and buy a futures contract, or in another case, go and buy a forward contract. What he's trying to do, because he doesn't know what the price of that maize is going to be in 3 or 6 months' time, is trying to protect his position, right? So take, for example, it's not uncommon for you to find the price of maize going from 100,000 naira per metric ton, to going to 200,000 naira per metric ton. Now, for most people who use maize in their production process, that's double your cost of production already. So in order for him to protect against that large or huge price spike, he protects himself in the commodities market by hedging his position. The farmer also wants to do the same, right? So the farmer who has, let's say, maize to sell at 100,000 naira per metric ton doesn't know what the price of maize is also going to do over the long term. So what he does is that he also sells forwards or futures contracts in order to protect himself, against prices falling significantly over the course of the entire commodity trading season. So those are usually the first type of commodity participants that you have. The second type of participants that you have are brokers and spot market traders. Now, these guys don't quote unquote care about hedging their position in the market. They're usually just taking the position in the market in order to take advantage of price appreciation, right? So much in the same way somebody would buy a stock in the hopes that it will go up in value over time, or somebody would short a stock in the hopes that it will fall in value over time. Speculators also do the same thing in the commodities market, right? So it's not uncommon for you to find speculators buying spot contracts, because they expect that spot contract is going to rise in price over time. Or it's not uncommon for you to find them shorting or selling, spot contracts because they believe that the price is going to fall, over time. The major thing to note here with speculators is they don't care about taking physical delivery of the commodities itself. They're only in the market to take advantage of short-term price movements, or in any case, medium-term, price movements, right? The last type of market participants are arbitrageurs, right? And these are investors who earn a discrepancy in prices between two exchanges or two different maturities of the same commodity. The best way to explain this is, so take, for example, let me use something that we can both, understand. Let's say, for example, the price of maize in Dawanau market is 100,000, and the price of maize in Mekarfi market, the price of maize in the same market in Mekarfi, which is in Kaduna State, is 120,000, right? Now, that means that for the same quantity of maize, there is a 20,000 naira difference, right? What an arbitrageur will do is it would buy that maize in Dawanau market where it's 100,000 naira per metric ton, and try and sell it in Mekarfi market where it's 120,000 naira per metric ton. That's as simple as it gets for arbitrageurs. They're different from speculators, and they're different from edgers. What they're trying to do, as that definition here stipulates, is that there is the same product at different markets at different price. Let me say that again. They can see the same product at different markets at different prices, and they're trying to take advantage of those price differential between the two different markets, right? They can either do this physically in the spot market, or they can do this electronically on the exchange traded commodity markets, right? But the main point of what they do is that they're trying to take advantage of price differences for the same commodity. Please note, price differences for the same commodity at two different markets. And these markets, like I said, could either be physical markets, or they can be electronic markets, or exchange traded, like we have the exchange traded commodity, market. So if you have any question, like David mentioned before, just write them down in the text box. We'll get to it at the end of the presentation. So just moving on, like I said, they're edgers, they're speculators, and then they're also arbitrageurs. So what exactly? So we've gone through what commodities are, the different types of commodities. We've also gone through the different types what commodity markets are, and the different types of commodity markets, and then the different types of players that you can have in the commodities market. Now let's talk a little bit about commodity exchanges, right? Commodities exchanges is a competitive and transparent marketplace for rule-based trading between buyers and sellers of standardized commodity linked contracts with clear terms related to price, quantity, quality, and or location. Now, all of that is a lot of English. Let me just explain it in the simplest way possible. A commodity exchange, like I said earlier, is a formal commodities market, right? Where every single interaction between the buyer and the seller is both structured and standardized. Let me say that again. A commodity exchange is a formal commodities market whereby every single interaction between the buyer and the seller is both structured and standardized. What I mean by standardized is with regards to certain parameters like price, quality, quantity, and the location of that commodity, everything is standardized, right? So take, for example, if you want to buy maize, on the Afex Commodities Exchange, you're only going to get one price for maize on the commodities exchange. And that's because every single price and every single quality of commodity passing through a formal commodities exchange, every single thing is standardized, such that every single player that is playing in that market per time, they're all aware of what quantity they're buying. They're all aware of what quality they're buying. They're all aware of price. Remember I said something earlier, right? That arbitrageurs try and take advantage of pricing in two different markets. In a standardized commodities market, that happens far less in comparison to, let's say, the cash or the OTC market, right? So what that means is that in formal commodities market, every single player knows what the price is. Every single player knows what the quality, the quality that they're buying, the quantity they're buying, and they also know the location from where they're buying. They know the source and the origin of the commodity that they're buying. So those essentially what commodities exchange are. They're a formal marketplace that facilitates standardized interaction. Underline that word in your notes. Standardized interaction between buyers and also sellers, right? It also says here that an exchange may facilitate efficient physical trade of a commodity or provide a venue for price risk management and also speculation. So just moving on, when you think about the commodities market, there is a lot that goes on in the background before you get into an agricultural commodities market, right? So in terms of the agricultural commodities market landscape, there are essentially three types of player that you would find, or even more in certain cases at any given point in time. The first level of interaction is with the primary producer. That's the smallholder farmer who goes to the farm every other month to go and cultivate maize, soybean, paddy rice, ginger, cocoa, sesame, or any other type of commodity, right? Is fundamentally, is fundamentally a producer and is an input provider, and most of them are farmers, right? Most of them, like I said, are farmers, and these farmers could either be subsistent farmers or commercial farmers. It doesn't really matter as long as they are primary producers of commodities, right? Moving on, you then have in the agricultural commodity market landscape, you then have marketers. These are essentially village aggregators and traders who buy these commodities from the farmers, right? And these are guys, and they're essentially a lot of them, right? So if you go into the traditional commodities market in Dawana or McCarthy or any other market, it's not uncommon for you to find a lot of traders in those markets trading commodities. Now, the only reason why they're able to do that is because somebody at the outset of the cultivation season decided to cultivate maize, soybean, paddy rice, or sorghum, and then brought it and sold it to them, right? So they're essentially what we regard in the commodity market as middlemen, right? They don't produce any commodity on their own, but they're able to buy from commodity producers who are smallholder farmers or commercial farmers, as the case may be, and then sell to the last person in the commodity market landscape, who is the off-taker. And these are usually the processors like, flour mills like Olam and the rest of them, who use these commodities, to produce cornflakes, bread and whatever, right? And bread. So those are essentially, broadly speaking, right, the three types of, players that you would find in any given, agricultural commodity market landscape, right? In terms of the exchange, remember I mentioned before, right, that in the exchange, a lot of the interaction there is whole lot more formal, it's more structured, it's more standardized. Then things get slightly more complicated. So there are essentially four different stages that you have, which is pre-trade, the primary market, secondary market, and then you also have post-trade. Elements of post-trade, pre-trade, elements of the pre-trade segment involve, production and grading, quality assurance, and usually, like I mentioned earlier, this would involve producers and also traders sometimes. The producers, like I mentioned, are the smallholder farmers and also the smallholder farmers and also commercial farmers rather. In the primary market, that's where you have the OTC market, and that's where you also have the forwards, right? OTC market, like I mentioned, is where you go to the market with your cash today in exchange for also the commodity today. That entire transaction is settled on that particular day. Let me say that again. In the OTC market, you go to the market with your cash in exchange for commodity, and that transaction is settled on that particular day. The other type of market you can find in the primary market is the forward market, right? The forward market is basically a bilateral agreement. There's a technical word I'm looking for, a bilateral customized agreement between a buyer and a seller to sell a particular quantity of commodity at a particular price in the future. Let me say that again. The forward market is a bilateral customized agreement between a buyer and a seller to sell a particular quantity, quality, and price, right, of a commodity in the future today. So it's essentially you going to meet, to give a very good example. This is you essentially, so let's say I'm a processor, right? Michael Martins is a processor. I go and meet Zaradogo, who is a farmer, right? And I tell Zaradogo that, Zaradogo, I need 100,000 metric tons of maize 6 months from now. What price are you going to give me? Zaradogo then looks at his, the volume that she has available and then says, I have 100,000 metric tons available. I'll sell it to you at 120,000, right?
that singular, agreement between myself, Michael Martins, and Zara Dogo, who is a smallholder farmer, is called a forward contract. So you agree today the price, quality, and quantity that you're going to sell to somebody else in the future. Right. So that's different. Remember, that's diametrically different from what I had mentioned with the OTC market, which is basically you going to the market today on Friday with 100,000 buying 1 metric ton of maize. The maize is delivered to you instantly, and then you carry that maize back to your house. Different from that is the forward contract, where you go and meet someone and you agree on the price, quality, and quantity today, but that quality and quantity isn't delivered to you until 2, 3, 4, or 6 months into the future, right? And the importance of this could also be price discovery, so that every single person knows, what they're buying per time. And then the primary users of this are also processors, right? So processors do this a lot. Like I mentioned, processors do this a lot. But the problem with this market is I can change my mind, right? And that interaction is not standardized, it's not structured, right? So if I decide tomorrow that I don't want to sell, nobody's going to hold me to it, right? Or if I decide tomorrow that I don't want to buy, nobody is going to hold me to it. Do you understand, right? So that's the way in which the forward market works. In addition to that forward market, you then have the secondary market, right? In addition to that primary market, or the next level after that primary market is where you then have the secondary market, which is your spot contracts, which is, you basically going to buy a spot contract on an exchange. So take, for example, on the Afex Commodities exchange, we have spot contracts that, investors, whether retail or institutional, can buy on day one. And the people who use spot contracts the most are usually investors or speculators, right? So, and like I mentioned earlier, speculators are just looking to take advantage of price differences. They're not looking to take delivery of the commodities. And in addition to spot contracts, you then also have futures contracts, right? Which are essentially one level above forward contracts, right? So as opposed to just two people agreeing on a forward contract, a futures contract is the standardized contract by an exchange that stipulates a particular quantity, quality, and a price that anybody can buy per time, right? So you can either sell a futures contract or you can either buy a futures contract. It's not a bilateral agreement. It's more of a multilateral agreement in that sense, right? So it's not just between two people. The entire futures contract itself is standardized, and it's structured on an exchange, right? And usually the role of the secondary market is to provide liquidity, and it's also to provide an opportunity, for different participants to edge in the commodities market. In the post-trade, you then also have storage, and then you also have central counterparties, securitization issuers, and then also other exchanges. So just give me a moment. I think I'm having, okay. All right. So moving on, we then have the fundamentals that drive commodity prices at any given period of time, right? The fundamentals that drive commodity prices are the fundamentals that drives any price in any market at any time: supply and demand. If you have an understanding of basic economics, you have a fundamental understanding of price movements in the commodities market. If at any point in time you have more supply than there is demand, price would fall, right? Law of economics number one. And if at any point in time you have more demand for a commodity than there is supply, the price is going to rise. The thing you have to note about the commodity market is the commodity market, especially the agricultural commodity market, is that it tends to be cyclical, right? What that means is that there are certain points in time when there is more supply than there is demand in the market. And it also means that there are certain points in time when there is more demand than there is supply in the market, right? Rationally speaking, during harvest period, that's usually when you have more supply than there is demand in the market. Why? The average smallholder farmer has cultivated, he goes to the farm, he harvests, he brings it to the market. There's a whole lot of supply during that particular point in time, right? After harvest, 6 or 7 months later, there's usually more demand than there is supply in the market, primarily because nobody is cultivating at that time, or better put, nobody is harvesting commodities at that time. So there are usually more people wanting to buy commodities than there are commodities available, which is why anybody who knows anything about the commodity markets will tell you that there is a general price dynamic that you're supposed to expect within the commodities market, which is basically you expect low prices at harvest because there is more supply than there is demand. And then you expect those prices to rise over, let's say, a 6, 7, 8 months period, depending on how, demand how quickly demand then overshadows, right, supply. The other fundamentals that drive the commodity market would include, disposable income. So this answers the question of how much money are people able to buy, how much money is available for people to actually buy commodities in the market, right? So if you have 100,000 naira in comparison to somebody who has 200,000 naira in disposable income, you can buy twice as much commodity, and this feeds directly into the demand for commodities at any given point in time. That's the amount of money that you have available. Secondly, you also have population, right? A rapidly expanding population will increase demand for commodities. I think that's simple, that's straightforward. The more people that you have in an entire, country, the more commodities that they're likely to consume, either directly, from the farm, or in terms of finished product, like you have cornflakes, like you have bread, and like you have bread and other commodities. Another thing that could also happen is consumer taste and preferences, right? So if in a particular country they consume maize a whole lot more than they do soybean, then you can expect the demand for that commodity to rise, significantly. Purchases by importer is also particularly important. So take, for example, if you have a country importing significant volumes of maize into a country, that would affect the demand for locally produced commodity, as opposed to if they could not import that commodity. So take, for example, the world is currently going through a lot in terms of having to import, or rather Africa is going through a lot in terms of having to import wheat from Russia. Right now we can't, because Russia and Ukraine are going through some sort of, they're going through a political crisis. That has impacted the price of wheat over the past 2 or 3 weeks, right? So those are the types of dynamics that you see play out in the commodities market. Then you also have environmental and cultural factors, right? So if it is the case that you have famine, or you have maybe a pest or a low-cost infestation, that's going to significantly affect the supply at any given point in time. Other factors include access to inputs. That is fertilizers, anyways. So the availability of fertilizers determines how much smallholder farmers are able to cultivate at any point in time. The actions of speculators are also important, but that usually plays more in advanced commodities market as opposed to local ones. Then you have weather, like I've mentioned before. If it doesn't rain as much as well or as much as it should, then you're going to have a big problem on your hand with regards to cultivation or even harvest for that particular season. Production levels and also land allocation are important. The amount of hectares that the average smallholder farmer has to cultivate determines to a large extent how much volume you're going to have available at available at production. Just to run through what we do at Afex Commodities Exchange, because I think we've taken a fair bit of time. So at Afex Commodities Exchange, most of our services include commodities trading, providing quality input to smallholder farmers, providing market access, right, to different players in the commodities market per time. So whether that's a smallholder farmer looking to sell his commodity, or a processor looking to buy his commodity, providing market access to both of them is one of our primary roles and services as an exchange. Providing storage and aggregation services is also particularly important, whether that's for the processor who wants to store his commodities because he doesn't need all of this volume at once, or that's for the farmer who wants to take advantage of future price rise in commodities, by storing that commodity today. That's also another service that we offer. Extension services in terms of training smallholder farmers in the different ways by which they can be more efficient in their cultivation, so that their production, so that they can increase their production, so that they can increase their productivity essentially, and then also financial inclusion, which basically stipulates the amount of training and the amount of training, not just training here, right? So with regards to financial inclusion, this involves the verification of farmer profiles and credit scores, inclusion in formal banking, and then also input distribution, right? So we support increasing access on the producer side, to financial services to facilitate better farm management and also better farm, entrepreneurship. So one of the things we do here is also to provide farmers with seeds and also inputs at the beginning of the season, so that they can increase their productivity over the course of an entire season, right? At Afex Commodities Exchange, I believe we have turnovers, close to about 35 billion naira at any given period of time. We've traded last year alone. We traded more than 500,000 metric tons. As of today, we have we've impacted more than 330,000 smallholder farmers directly, and these have increased their income by around 300% over a 2-year period for about 4,500 households. Today, we have more than 100 warehouses covering more than 24 states. And our focal commodities are maize, soybean, paddy rice, sorghum, ginger, cocoa, sesame, and also cashew. Essentially, the work that we try and do, or the work that we do in Afex, covers three broad themes. The first of which is infrastructure, right? So we all understand that there's a big infrastructural gap in the country. Us as the exchange, we're trying to cover that gap in terms of providing warehouses for smallholder farmers, and also provide all the necessary additional infrastructure so that we can facilitate the seamless flow, of exchange of capital for commodities, and then also vice versa. Like I mentioned earlier, another thing we also do is provide access to market for different players, across the commodity market value chain, right? So it states here that 4 out of 5 commodity market participants have limited access to buyers, meaning that the average smallholder farmer, doesn't have access to buyers, or even if they do, they're usually not given the best price possible for that particular, for their particular commodity, right? And then lastly, we also have capital. Here, capital equals agency, and we believe that the commodities market can be leveraged innovatively to drive investment to the agricultural sector. So the way in which we do this is by designing special financial products that would aid the inclusion or the infusion of capital into the commodities market at any given point in time. So, for example, spot markets allow investors to participate in the market. Spot contracts, rather, allow investors and speculators to partake in the market. Input notes allow people to allow investors to subsidize production for smallholder farmers. Futures contract and forward contracts allow participants in the commodities markets to edge their position in the commodities market at any given point in time. So all of the financial products that we have on the exchange are designed to facilitate the flow of capital from investors into the commodities market, and also drive investments in the broad agricultural market. Like I mentioned earlier, in the physical market, we have maize, soybean, paddy rice, sorghum, ginger, cocoa, sesame, and cashew. In the financial market, we have options, futures, forwards, and also futures, which I've explained before. In terms of structured market, we have repo agreements, ETC indexes, and then also trade finance notes. Trade finance notes are more readily used for the export markets. And then for fixed income products, which are similar to the bonds or the treasury bills that people trade on a day-to-day basis. In the commodities market, we have asset-backed commercial papers, SDG bonds, and then we also have input notes. In terms of markets that we will be developing on the exchange over the next couple of months, we have gold, we also have power, and then we also have energy. In terms of products that currently exist on the exchange, like I mentioned before, we currently have spot contracts, which is basically you trying to take advantage of price appreciation in the market at any given point in time. We have the asset-backed commercial paper, which is essentially like a fixed income note that promises a fixed rate of return over a 270-day period. We also have the exchange-traded commodity, which we call the ETC, right, which is a 270-day investment basket, right? So these are investment vehicles, asset-backed securities that track or replicate directly or indirectly linked to the performance of an underlying asset, right? So an ETC is essentially like a basket of spot contracts that allows you to take position in the commodities market of multiple commodities per time. So, for example, when it comes to spot contracts, you can only buy either maize spot or paddy rice spot contracts, but with ETCs, you can buy a basket of those spot contracts at once and then ride, the price. Last but certainly not least, we have the trade finance note, like I mentioned, which is basically used for export commodities. And then you also have the input financing notes, which is used to subsidize production for smallholder farmers. In terms of market performance, historical market performance, right? From the year 2017 to as we have it today, you would notice that commodity prices tend to rise significantly over an extended period of time. For maize, it has risen from around, I believe, 12,000 to today, somewhere around 30,000 or thereabouts. This data is a bit dated, so this data is a bit dated. So pay less of a mind to that, to the data trends that you have on the left. What I want you to focus on is what the average return has been for the commodities market over the past couple of years, right? So the 4-year average return for maize is 32%, for soybean is 33%, and for paddy rice, I believe, is 18%, right? And what this tells you is that at any given point in time, at least we can say categorically for the past 4 years, the commodities market has done significantly better than the rate of inflation. For coffee, I mean, rather, I said for coffee. For cocoa, you have 9%, and then for ginger, you have 71%. And these are returns, average returns over a 2-year period. The next slide goes into a bit more detail with regards to the volume traded on the exchange at any given period of time. And this speaks a lot to the fact that you tend to have higher volume on the exchange, during times of harvest in comparison to, much later in the commodity trading season, right? On the exchange, you also have indices or indexes, as the case may be, like the Afex Commodities Index, which is like a basket of 4 different commodities, and it just measures, it gives you like a broad overview of what is happening in the general grains market at any point in time, right? So as opposed to you having to track the price of just one singular commodity like maize, soybean, paddy rice, or sorghum, you can then track, the price. You can then track the changes in an index, which helps to give you an overview of what is happening in in the commodities market with regards to grains at any single point in time. You then also have the Afex Export Index, which is the AEI, which does the same for the export market. One of the reasons why we believe the exchange, the benefits of people playing in the commodities market is it's an edge against inflation, and it's also an edge against the exchange rate. So as you see on the chart here, there's a 63% correlation between the Afex Commodities Index, which is what I mentioned before, as the basket of grains that we have on the exchange, and the exchange rate in the country. We know categorically that the exchange rate is broadly correlated. And when you compare that with the correlation between that the exchange rate is strongly correlated to inflation in the country, because for the most part we're an import-dependent economy, meaning that if the exchange rate, if the currency of the country is devalued, then you begin to see higher prices cross-border for most of the commodities traded on the exchange. For a lot of other reasons, but that we can't go into right now, to a large extent, that the trading in the commodities market is a very good edge against inflation. So I believe that's the end of the presentation. I think we can go into a bit of detail with regards to how to actually get started trading commodities, on the exchange. I'll call on my colleague. But anyways, I think we can take questions before then. Okay. Do you know what? So change of pace, right? I probably prefer that we just go through the presentation first, and then we can just take all the questions at the end. So Zara, can you help?
Good morning again, everyone. So now we'll just quickly go through the second half of this presentation, seeing as we've lost a lot of time. Please, can someone confirm that you can see my screen?
Hello, Sarah, we can hear you. But your slide is not showing yet.
Can you see my screen now as well?
Yes, can see your screen.
Okay, so once you have signed up, which I believe most of us on here have, if you haven't, to sign up on the exchange, I think once you share the deck, it's available on what Michael presented. So once you have that, you're able to sign in to the app. So once you're able to log on, this is what your dashboard typically would look like. It shows you an overview of what we have on COMEX. It shows you how to fund your wallet, how to view your portfolio, quick actions on how to do all of this. On the right side of your screen, there's a green button which shows you live. So on here, you're able to switch to demo, which is red. So if you haven't traded before, you're able to fund your wallet with fake money. You're able to play with the products that we have available on the exchange, just to have a feel of COMEX before you're able to actually trade live. So we will go back to live so we can actually see how to buy and sell. At the bottom of your screen, it shows you the live prices of all of the commodities that we have listed on the exchange as at today. So that gives you a better understanding of what you're buying and what you're selling on the exchange. The first thing to do once you have logged on would be to fund your wallet. To fund your wallet, you have two options, and that is either through bank transfer. Sorry, let's just have that come up. Sorry, I think I'm having network issues. It's a bit slow. So to fund your wallet, you can do that through bank transfer or through card payments. Usually you would have those two options on the screen. For card payments, you're able to do that through either Flutterwave or Paystack. And for bank transfer, you put in the amounts that you want to fund your wallet with. You're able to generate a token. You can take that to the bank and you're able to make a payment on your phone. So once you've done that, the amount that you have within an hour or two, or even less, more often than not, the money comes into your wallet, which shows here as your total balance. So usually the same way you're able to fund your wallet is the same way you're also able to withdraw from your wallet. I think due to network issues, this is not coming up. So usually that would pop up on the left side of your screen on how to withdraw. So once you've funded your wallet, you're able to buy and sell on the exchange. So you click on markets, and on product view, it shows you all of the products that we have available on the exchange, both cash settled and physically settled. So once this loads, I will just scroll through and we can have a look at the products available. Okay, so on this screen, on this page, it shows you everything that we have deliverably available. It shows you our fixed income products. It shows you all of the sports products that we have available, like cocoa, sorghum, soybean, sport cashew. It shows you the current price, the board for all of these products, the number of deals. Right now, it's showing not set because I am using a demo page to show us all of this. So take, for example, we wanted to buy, let's say, soybean. You click on soybean, and that shows you how to create a buy order for that. So looking at our page, it shows you how much you have available in your wallet. Coming under Author Stevens, the community that it would show you here would be Author Steven. I would go quickly to community after we've created a buy order here. So it shows you the number of units that you have if you have already purchased soybean. You impute the number of units of soybean that you want to buy. Say we wanted to buy 2. The current price is 350. We put in a buy price for, say, that 350. Usually your order is valid for 7 days. So if it's not matched within 7 days, it is automatically cancelled. If you put in your order and you wish to cancel, you can cancel within 7 days. And if it is matched within 7 days, it goes through and you get your contract note. So there is a general breakdown of your buy order here. So we bought 2 units of, so we want to buy 2 units of soybean. That would be 700 naira. There's a brokerage fee of 0.75%. There is a SEC fee, an exchange fee, and also VAT, which brings the total amount payable to 711 naira 66 kobo, and we're able to place that order. So the same way you create a buy order is the same way you create a sell order. So this has not been matched yet. So typically I cannot show us how to create a sell order right now because that hasn't gone through, but it's just the same way you create a buy order. Now we had seen something on the buy order page, which was community. So coming under, if you're looking to invest under Author Stevens, you would use their referral code, which they would share with you. That should automatically take you to their community. So if you're buying or selling on your own, once you create a buy order, it shows you your receiving community, and that way they are able to earn brokerage fee. If you are investing on behalf of yourself or on behalf of your own firm, you're able to create your community on COMEX. So once you have created that, this would typically come up on your community. So that would be your community details, which entails when you created it, the number of members you have in your community, the name of your community and the community type, which typically would be broker dealer. So looking at forum as a community, you're able to start a conversation with your clients, which could be about commodity markets, about the commodities that we have available on COMEX. It could be any conversation related to trading commodities. And once you click on trade, this shows you all of the transactions that have occurred within that community. So it shows you a proper breakdown of the securities that were bought, units of each commodities that were purchased, the price at which the transaction went through, and the commission that comes to the broker on here. So I think this is pretty much the breakdown of what COMEX looks like. Looking at portfolio, this shows you how much cash you have available in your wallet. Once you click on securities, it shows you all of the products that you have in your portfolio. So if you bought spot contracts, that comes up here. If you bought fixed income or you bought physical commodities, all of that comes up under securities. And clicking on reports, this shows you statement of account for every time you've either funded or withdrawn from your account and for every transaction that has gone through. If you've done physical transactions, that comes under dispatches. So this is just a very quick breakdown of how COMEX works. On the right side of the screen, it shows the latest news in the commodities markets, shows you the latest news in the investment markets as well. You can click on Learn How to Trade, which shows you how to navigate the platform. It gives you a breakdown into the different products that we have available on COMEX. There's also conversations regarding investment on here. So if you're looking to have a better understanding of the investment industry or the commodities market, you can click on Learn How to Trade. Also, on this side of the screen, we have market reports, which we send out to our clients weekly. So if you're looking to go through the reports that we have on the exchange, you can come on here and that shows you all of the reports available on COMEX. So I think this is, I'm pretty much done with this, and we will take questions now.
Okay, thank you, Sarah. And Michael, that was a wonderful presentation, and I believe that people had already, I have a lot of questions here. I'm checking my YouTube. I discovered that about 8 people are on YouTube, and I quickly want to pick the only question we have on the YouTube to Michael now. Somebody asked, Mr. N.I. from YouTube. Mr. N.I. from YouTube says, does the forward market consider inflation? Does the forward market consider inflation? From the YouTube.
I mean, to be honest, right, I'm not sure that question. So let me answer the question like this. I'm guessing what the person is asking is whether or not that agreement takes into account inflation, right? And you have to be careful when you talk about inflation, because inflation could either be increase in the price of the commodity itself, right? Or increase in the price of every other thing aside from the commodity, right? So there are 2 different scenarios, right? The first thing I would mention is this, right? If it is with regards to increase in the price of the commodity itself, that forward contracts takes it into account. Let me explain what I mean. Like I mentioned, right, the forward contract is a bilateral agreement between 2 people. If I go and meet, let's say, Zaradogo today, who is the small order farmer, and say, sell me maize ads, sell me maize in 3 months' time. maize today may be 100,000, yet the price that is agreed in 3 months' time may be 120,000. That's a 20,000 naira difference, right? So that takes into account the fact that the price of that commodity would probably increase over that time period, anyways. Your best hope at the time, or my best hope at the time, is that that price doesn't fall as the person who is buying the contract, right? Is that that price is not less than 120,000. Because if the price at the market in 3 months' time is less than 120,000, then I'm going to have made a loss. I don't know if you understand what I'm saying, because that would mean that I would have to go and buy from that forward contract as opposed to buying in the market itself where it is lower, right? But if the price stream in 3 months' time is 140,000, right? But because I've agreed 120,000 with Dogo, I'm saving myself from having to go to the market to buy at 140 because I already agreed with somebody 3 months ago that I was going to buy at 120. Right. So with regards to that, the forward contract takes into account the movement in the price of the commodity itself. It is almost never the case that the price that you will charge on a forward contract is exactly the same as the price that you will charge today. It is almost never the case. In fact, it is never the case categorically, right? Because, for example, the person that you signed the contract with to supply you maize in 3 months, first of all, fundamentally has to pay for the cost of storage, right? Has to pay, if he borrowed money to buy that commodity, he also has interest payments to pay on that commodity. So all those additional costs are the reason why the price in the future is usually higher than the price today. So the forward contracts in that regard takes into account, inflation itself. With regards to the broader, question of whether or not the forward contracts takes into account, the broader inflation in the macro in the economy, I would say it's not part of the conversation. But to the extent to which investing in the commodities market itself is a hedge against inflation. What I mean by that is, when you see inflation going up by 10%, that's usually, not always, right, an indication that commodity prices would also rise. Because part of the computation of inflation itself are commodity prices, right? So there's some commodities that are used as part of the computation of inflation, right? So meaning that if at any point in time you're invested in the commodities market, what that means is that that's the best edge, as far as I'm aware today, available against inflation, the broad economic inflation, right? So I think that's how I'm going to answer the question. Right.
Okay, thank you, Michael, for that. I have some few questions here. I don't know if I should call out the question first, or
Yeah,
I
it's
should. That would be fine. Someone asks, FTN Cocoa is listed on Nigeria Stock Exchange. Is it not supposed to be part of commodity market? That's the question for someone.
Okay.
Then what are the features of the future and forward exchange markets and their differences? What are the future of the future and forward exchange market and their differences?
Okay.
The next question says,
so before let me answer the first two questions before.
Okay, maybe you can answer.
Yeah.
Okay.
All right, thank you. So with regards to the FTN Cocoa, right? Remember I mentioned that for you to trade on any exchange, the Exchange Act has to set forth, specifications and parameters by which you can trade on that exchange, right? What that means is that for you to trade any sort of commodity on the exchange, they have to meet a certain grade and they have to meet a certain standard for you to trade. FTN Cocoa is not, quote unquote, owned by Afex and is not in any of Afex's accredited warehouses. Hence why FTN Cocoa can't trade on commodity exchanges, right? Now, that's not to say that FTN Cocoa is bad. Don't get me wrong. That's not what I'm saying. I'm saying that with regards to the specifications delineated by Afex Commodities Exchange, FTN Cocoa may not meet that standard, right? Hence why you can FTN Cocoa trading on a stock exchange as opposed to trading on, let's say, a commodities exchange. If it ever does become the case that FTN Cocoa is seated in any of Afex's accredited warehouse, and we can guarantee the quality, quantity, and also the price of that cocoa itself, then FTN Cocoa can start trading, right, on Afex Commodities Exchange. But remember where we started this conversation from, right? On the exchange, there is a specific how do I call it? There are specifications regards to the price, quality, and quantity of every single volume that trades on the exchange. Meaning that when a when when a commodity comes into an exchange, it is not called FTN Cocoa again. It is going to be listed under the contracts that those exchange has, or under the contracts that that exchange has. I don't know if you understand what I'm saying, right? So when it comes to the exchange, it's not trading at SAN Cocoa, it's trading as cocoa, because cocoa on the exchange would have a certain specification, certain grade, and certain standards by which every single cocoa that is trading on that exchange must meet. And FTN Cocoa, for it to be able to trade on that exchange, must meet those specifications. That's the answer to the first question. The second question says what's the difference between a forward contract?
Futures.
What's the difference between a forward contract and a futures contract? A futures contract is tradable, a forward contract is not. Remember, I said that the futures contract is multilateral, meaning that multiple people can trade a futures contract at any point in time. With a forward contract, it's a bilateral agreement, me and you, Michael and Zaradogo, right? Which is why one of the demerits of a futures contract, or a forward contract rather, is that I can change my mind. There is no standardization, there is no specification. It depends on what myself and the other counterparty agrees on day one, right? So if I change my mind tomorrow, the liability, nobody owns the liability, and you can't take anybody to court because there's usually no signed agreement or any. Maybe there is, but it's usually not enforceable. But with a futures contract, the liability lies on the exchange where that futures contract is traded. Meaning that if I buy 1,000 metric tons of futures contract today, I don't care who the other person is counter selling that futures contract, as long as when that futures contract expires, I get delivery of my 1,000 metric tons of cocoa. I remember what I said, for that volume to trade on the exchange, it's going to have to pass a certain quantity, quality, and price and grading specification. So that's the major difference between a forward contract, which is bilateral, and a futures contract, which is tradable on an exchange, right? So people can get in and out of a futures contract much in the same way they can get in and out of a spot contract at will. What happens, what is the most important is that the liability is not on any single individual. It's on the exchange to make sure that the guy who is selling the futures contract delivers, and to make sure that the guy who bought the futures contract gets delivery of his commodities. That's the difference.
Thank you, Michael. Now, before I call the other questions there, I would like to give room to some people that are raising up their hand so that we know that the audience are following us. So I would like to open the floor for person name is not there, but I can see Techno 3. Yeah. Please, you can ask a question, please. Techno.
Hello.
Please, you are free to ask your question.
My question, I heard about the broker specifically that is inclusive.
Please, a little volume, please.
I mean, about the broker, we personally as investors in the broker, what are
Please, we cannot hear you. Please, maybe you can increase your volume. And please, when you're asking questions on the platform, please kindly help us to introduce yourself. Since some of you did not put your name, either you're using your phone or using your phone name, you can help us to introduce yourself. And please.
Hello, are you hearing me?
Still not audible. Okay, we can move on, Michael. Because of our time, the next question that I have here is, does the price traded on commodity market equivalent to the prevailing market price of product outside? What is the parameter for price in the exchange and in the real market? For instance, rice, bag of rice, is it a comparison between bag of rice and the price that you are having at the exchange? What are the parameters that you are using to get your price compared to what the market is saying in in the real market outside there. You take, for instance, the Lagos market. That's the last question. Then, just to confirm, can one sign into the ComEx site? I think Sarah has answered that, but she can still put more light to that. Then the question number 7, for forward and future, do you exchange cash? For forward and future, do you exchange cash? Michael, you are welcome to answer the question, please.
So with regards to the first question, and the fundamental question is this: what's the difference between the price on the exchange, or what feeds rather into the price on the exchange, in comparison to, let's say, the price of that same type of commodity, right? Somewhere else. Let's say, for example, Lagos market. I don't know if Lagos market would suffice at this point, because people don't necessarily trade commodities in Lagos market. They'll probably trade it up north, in Dawana or in Funtua or Mekarfi or all these different markets. In any given case, right, what you'd expect is that the price on the exchange isn't that far different from the price in the local commodities market. Let me say that again. In any given period of time, what you would expect is that the price on the exchange is not far different from the price in the local commodities market, but they can never be exactly the same. And the reason why that is this: the price dynamics on the exchange is different from the price dynamics in the local commodities market. Take, for example, if you have spot contracts on the exchange, there may be more demand for that spot contract on the exchange, influencing its price, right, in comparison to the demand for that equivalent commodity in the local commodities market. Let me explain what I mean. If I have 100 billion, right, today, and I take that 100 billion to Dawanau market, that's going to affect the price at which maize is, and I take it to Dawanau market to buy maize, right? That's going to affect the price of maize in Dawanau market, but it's not going to affect the price of maize on the exchange. Why? Because that trade did not happen on the exchange. So in that scenario, it would not be uncommon for you to find that the price of maize in Dawanau market would be higher than the price of maize that you would see on the exchange. Why? That they're different supply and demand dynamics, right? Now, if I take that equivalent 100 billion and I don't take it to Dawanau market and I take it to buy spot contracts on the exchange, that's going to affect the price of maize on the exchange, but it's not going to affect the price of maize in Dawanau market. Which is why I've said in any given period of time, you don't want there to be a big difference, right, in the prices that you have on the exchange and also the prices that you have in the local commodities market. But you also have to remember that in the local commodities market, you would tend to have multiple price points for the same commodity depending on the grading standard. On the exchange, you would tend to only have one, right? So that's the answer to the first question. What's the second question again? I think I sort of missed the second question. Can you remind me, David, please?
Yes, for forward and future, do you exchange cash?
Yes. So yes, on the forward contracts particularly, you exchange cash, but you exchange cash at delivery, not when you're making the agreement. Do you understand? So you exchange that cash at delivery. So if I come and I make an agreement with you today, this is the month of March, and I say deliver cocoa to me in June or in July. That cash doesn't exchange until July, even though we've made the agreement on today in March. It's the same thing with the futures contract. But with the futures contract, it's less likely for you to have that type of price dynamic because, like I said, most people who use futures contract, they use it to edge their position. If it ever becomes the case that there's going to be an exchange of cash with futures contract, it is also going to be at the delivery of that futures contract, right? So what the exchange will do is that the guy who is selling the futures contract, the exchange would have made sure that they had a specified quantity in an exchange accredited warehouse so that they can deliver on that commodity at expiry. For the guy who also bought that futures contract, the exchange would also make sure that he has the requisite cash in order to offset the full value of that futures contract, such that when that futures contract expires, the cash at delivery is then exchanged for the commodity at delivery. So there is an exchange cash in the forward and futures market. but that exchange only happens at delivery. So
Okay. Michael, I would like to ask two more questions so that we can move to the next stage. There's a question here that says, can we can see the impact of commodity trading on farmers as Sarah analyzed. What efforts are you putting in place for illiterate farmers to have understanding of commodity markets? That is one. Then, are contracts for difference allowed? For example, if both parties do not want delivery to happen.
can you repeat that last question again? The person was asking
Are
about CFDs.
contracts for differences allowed? For example, if both parties do not want delivery to happen. I really don't.
To be honest, right? So with that last question, and I'm trying not to forget the first question that you asked. So the first question was about what Afex is doing, right?
Yeah, the
so
first
like I
question is
mentioned
talking
earlier,
about
right?
the first question is talking about what's due to the analysis of Sarah, that's what efforts is Afex putting in place for those illiterate farmers to have understanding of commodity markets?
So like I mentioned earlier, right, in addition to providing input, and what I mean by input is fertilizers, herbicides, pesticides to these smallholder farmers when they want to cultivate, when they want to cultivate. In addition to that, we also provide training and extension services to smallholder farmers, right? So we train them on best practices with regards to how to cultivate, how to harvest, and and even a whole lot more than that. What you would find is that most of the smallholder farmers are organized into cooperatives, right? So it's easy for you to aggregate all of them in a single location and give them the training and extension services that they need, right? The second question is with regards to CFDs. As of today, we don't have CFDs for the commodities market. At least as far as I'm aware, I don't think we have it in Nigeria. Where you tend to see CFDs play out a whole lot is in the currency market, at least as of today, right? And CFDs are a bit complicated insofar as CFDs just facilitates the flow of capital from one person to another. There isn't really a creation of value in that sense. And with CFDs, there is usually no collateralization, or there's usually no collateral. With trading anything on the exchange as of today, collateral has to exist. What I mean by that is this: if you buy a spot contract today on Afex Commodities Exchange, that spot contract is backed by a physical commodity in one of Afex's accredited warehouse. So if you buy 100 kilogram of maize on a spot contract, even though you're not taking delivery of that commodity is physically somewhere, right? That spot contract is backed by a physical bag of grain somewhere, and in one of Afex's accredited warehouses. With CFDs, you don't have that type of framework. Most people just use, or most CFDs that are used today, they're just used to transfer purely for speculation. Somebody believes the price is going to go up. The other person believes that the price is going to go down. Both of them exchange those contracts for differences, like you mentioned. And depending on what eventually pays out with the price, money exchanges hands, right? And like I said, you're most likely to find out within the currency market than you would currently find today in the commodities market. Yeah.
Okay, thank you. The last question is from our research from Dr. Stephen. And our research says, if we analyze the commodity market and post on our community, will member of our community get a notification?
I'm sorry, can you repeat that again?
This question is from our research. It says, if we analyze the commodity market and post it on our community, will member of our community get a notification of the analysis?
Yes. Yeah, so essentially every single person in your community has access to all your correspondence, right? And the essential premise behind you owning a community is that fine, you have a unique understanding, about the commodities market, and you can then begin to educate other people within your community the best, type of positions to take in the commodity market per time. right? So if you share any correspondence, it is, you know, most of your commodity, if not all of them anyways, are notified of what that correspondence is, and you can just sort of act in unison in that regard. So yes.
Okay. Thank you, and thank everyone. I want to appreciate Michael, Zara, and your team for this wonderful job being done this afternoon. And I believe that we all have a better understanding of commodity market trading. And I believe we have one of these days we also come back again while people try to trade. Maybe they might have one question or the other to ask again. Then we will bring in Michael and Dogo to come and explain better whatever we need to know about commodity market. Meanwhile, while we move on the next 10 minutes, we quickly also want to talk about Nigeria capital market using Assam E-Trade. I would like to share my screen now. We are moving on to how do you take Nigeria capital markets using Assam E-Trade. Assam E-Trade is a platform whereby you can trade on your own. For those that are already our clients, you know that some of our clients that are even in diaspora, they don't need to send their mandate to us again. Once they log in into their account with us, they can trade their market either by buying or selling whatever product they want to sell. And when you sell, you can fund your account wherever you are to buy your product. And once you sell, your account, your proceed goes into your account, whereby you send a mail to us that we should credit your account that is registered with us. It is very important to note that it is your account that is registered with us that will be credited. Due to security reason, we will not trade for Mr. A and credit Mr. B's account. That is the rule of SEC. And we follow the rule of SEC in auto-steering. So I will appreciate you if you can also follow that with us. While I share my screen, I just want to talk about Assam E-Trade. And for you to get to Assam E-Trade, our website is www.autosteeringonline.com. I believe that you can see my screen wherever you are right now. This is my screen, www.autosteeringonline.com. Just like we have an analysis have been given to us on the commodity trading, the same way goes to capital market trading. When you log in into your account, a code will be generated. Each client has they all have their unique code that they can use to log in and their password. Now I log in as admin now, and this is the platform whereby you can trade any stock on the Nigeria capital market. Equity, any equity trading, you can do this here. Like I said earlier, you can fund your account directly from wherever you are, and that's where you see where we have deposit fund. Deposit fund, clicking on deposit fund, you can see Flutterwave. You can decide to use your Flutterwave to fund your account and using your card. You get to a particular place whereby it will tell you to put your card, the amount that you want to fund your account with, and once you click on transfer, the fund will hit your account immediately. Thereby, you can do your transaction immediately. You can do your transaction immediately. And you can also, as well, under investment, check your portfolio. You can check the portfolio holding that you're having. You can say, I'm using admin now. Once you log into your account, once you click on portfolio holding, to show you the number of shares that you have. So if there's difference between what you have purchased with what you have in your portfolio holding, then you have to let admin know that there is discrepancy between your purchase and what you are having in your account, which we call for attention immediately. You have to do reconciliation with the CSCS. I know that many of us know what CSCS is. That's where all your shares are being lodged with the security exchange. So please, once you log into your account, you must click your portfolio holding to check if what you are having is equivalent to what you actually traded. And you can check the summary of your portfolio by you click on portfolio summary. Portfolio summary helps you to see the analysis of all your transactions, what you bought, the price at which you purchased it, the time that at which you purchased it, the current price, and the price and the gain or the loss that you have made. It helps you to see the analysis of your gain or loss. If you have made a particular percentage, you will see it from the summary of your portfolio. you'll be able to take your decision either to buy more or to sell that portfolio. So instead of you calling your broker, what is my stock now? How much is my stock? And you can easily log in into your account and check what is your stock doing without calling anybody. And you can take your decision from wherever you are. Then if you want to trade your account, just like I said, I believe that some of our clients that are here before, they are already familiar with this. But for the benefit of those that are joining us for the first time, and they might have been seeing Assam trade from the video that we displayed while we started this webinar, they might be asking what is Assam trade. That's why we are trying to introduce Assam trade to you again. Assam trade is a platform whereby you can trade your stock wherever you are. You can trade your stock on your phone, you can trade your stock on your computer, anywhere you are, in as much as you have internet access. You can have access to your stock. So, having said that, if you want to trade your stock, you can go to trade. Under the trade, it helps you to see the analysis of the capital market. It helps you to see the analysis. For instance, I want to buy MTN, and take note, if you don't have money in your account, the trade will be cancelled. No matter what you put there, it will be cancelled. So you must make sure that your account is funded before you can move ahead to buy. But if you want to sell, you must make sure that what you are selling is what you have bought before. You cannot put in what you did not buy that you want to sell. The system will automatically cancel it. So I decide that I want to buy, for instance, I want to buy FBN. Once I click on FBN, this system will show the analysis, because the market is live now. It will show me the analysis of what the market is trading at present. If you look at it, the current price for FBN is 12 Naira now. If you look at the right hand of this analysis, you will see that there are top bidders and top offers. That is, the top bidders means that the number of people that it's ready to buy at so amount. This is the amount that they want to buy. You can see at 12 Naira, we have about 1,017,837 units that are ready to buy at 12 Naira. But yet they got no supply yet, because the people that are ready to sell want to sell it at 12 Naira 10 kobo. And the volume at which they want to sell at 12 Naira 10 kobo is 145,767. You can see the difference in the demand and supply there. The demand is very higher than the supply. That means that if these people really want to buy, just like we were told in the commodity market, if these people really want to buy the first bank, that means that they have to increase their price because the demand is high. Assuming that it is on offer, maybe it's the people that want to sell that's around 2 million. That means that the supply is very, very high, which means that the people that want to sell, if they truly want to sell, have to reduce their price a little in order to meet the people that are demanding. So this is where you do your analysis. Take, for instance, you want to buy 1 million units and you are saying that it's only 145 that is supplied. You can see that you cannot get all what you want to buy. So these are the little way to get analysis of what you are purchasing. If you change this stock code now to another stock code, take for instance MTN, I'm changing it to MTN. You change it to MTN, you can see the analysis of what MTN is doing at the moment. The price of MTN at the moment is 204. The current price of MTN at the moment is 204, and the bidding, people that want to buy are saying that, okay, we are ready to buy it at 205. Why the people that want to sell are saying that, no, we want to sell at 206.50, and the volume at which they want to buy it at 205 is 70,154. Why the volume of the sellers are 2,300. So these are the ways that you can do your little analysis before you move on to take your decision and say, okay, give me 1,000 quantity of what is being bidded there. Okay, 70,000, I want to buy 1,000 out of it. Now we have what we call market order. Market order means that you are telling the system that buy it at the current market price. So the system will fix it in and it will purchase it for you at the current market price. So we also have what we call price limits. You can decide to change your price limit that, no, I want you to buy it for me when the price is at 204 exactly. You can change the price limit to 204. That means that the system will queue it in until the price comes to 204. And if the price did not come to 204 for that day, if you did not change your date limit, you can change your date limit to 7 days. Within the 7 days, if the price falls to 204, you can buy. But if you do not change the price limit and you leave it at the 25, immediately after the trade of today, the system will automatically cancel the trade. So don't come tomorrow and say, but I've already put this thing in. Why is it that it's not giving me at 204? Maybe the price eventually falls to 204 the following day. That's why you have to come and check the following day if you put a date limit. If you do not put a date limit, you have to put it again the following day, because the system will automatically cancel it immediately after the trade for that day. So these are the analysis that you need to follow when you are doing your trading. Now we have other way at which you can do your trade. That's one of the method at which you can do your trading. And we also have what we call live trading terminal. Live trading terminal means that it shows you the analysis as it's being done on the Nigerian market with brokers. How it's being done directly with brokers. When you click on web trading terminal, it takes you to another platform entirely, whereby you can see the terminal of how the old analysis. You know, what I clicked here before was showing me the analysis of a particular stock that I want to trade on. Take for instance, I have to click on MTN at a particular time. I have to click on a First Bank at a particular time. But in the case of this terminal, sorry, 1 minute. In the case of this web trading terminal, it shows you more details, more analysis on how. Okay, I think it's coming now. Oh, still giving me error. Okay, just a moment. Loading. Okay, before it loads. So as for trading purpose, then you can also do what we call research on a particular stock that you want to trade. Under research, you can do market watch of a particular stock. When you click on market watch, it takes you to where you can see all the trading platform. In fact, the web trading terminal can also show you that platform as well. The platform that I want to show to you now, that web trading platform can also show it to you. A moment, please. Okay. Let me continue with the research. Then you can also stimulate your portfolio. Like I think I've shared this with some that have been doing a webinar in the past. Stimulating your portfolio means that you don't even have money in your account. You want to be monitoring a particular stock. Take for instance, MTN. How is MTN doing for the next 1 week or for the next 2 weeks? Is it going up or is it going down? You can stimulate it. Stimulating it means that you can put it in your portfolio, but it will not be added to your main portfolio. It will just be a stimulated stock, whereby you can watch a particular market. For instance, MTN. I've clicked on MTN. The number of the price is 204, and the number of units you want to stimulate is 100 units, or let's say 1,000 units. The date is today's date. Date is today's date. It will give you the total amount. Once you click on add to portfolio, it will add it to your portfolio. And when it adds it to your portfolio, it will give you the analysis. That is, this is MTN Nigeria. You have 1,000 units. The price for that 1,000 units is 204. The closing price is 204. So there's no gain, there's no loss. So for the next 1 week, if there's any change in this price, the system will automatically adjust it. Whereby you can see how the market is moving, whether it's going up or it's coming down. So you can stimulate a particular stock to see how what's the range at which the price is moving. That is what the stimulating does. I want to check if, okay, now I have the second trading platform. In this my second trading platform, what you have here, I believe you can see my screen with this second trading platform. What they have there, it will show you all the symbols. You'll be able to see all the symbols, and from this place, you can view any of the stock that you want to trade. You have what we call this green light plus. This green light plus shows you that you can buy using this green light spot, while you can also click the red circle spot telling you that you can use that as sell. That means if I am buying Academy now, I can click on the green for buy. Once I click on the green, it takes me to a platform where I can input the number of units I want to buy. And if you click on the red, that is the minus, it can also show you the number of units that you want to sell. So this is very simple. While you are still on the platform, you are doing your trade rather than going out to go and click on buy or sell. You are on the platform. All you need to do is just to scroll down to where the stock or the symbol which you want to trade on. Once you are on the symbol, you are able to trade the stock that you want to trade on. Take, for instance, I want to buy Alex. Once I click on buy, to give me a platform whereby I can do my transaction. Immediately I finish my transaction, I just close it. I come back to this place again without leaving the page. Without you leaving the page. So you can come back and quickly browse on any other stock and purchase while you are still on the same page. That is that for the ASAP iterate for today. I will also give room for more questions. Thank you. Yes, if you want to buy, somebody ask question that will it buy at current market price? Yes, if you put it at the current market price, it will buy for you. Yes, once you put your unit and you put it at current market price, if the current market price is 204, the system will automatically buy it for you at the current market price. Whatever that is traded at that moment, that is what. But if you put a price limit, you might likely not get it that day because you have already put a limit that if it gets to so price or if you go above so price, sell. So if it did not get to that price, that means that the transaction will not be executed. If it gets to that price, it will be executed. And it depends on the number of people that are on queue. If the number of people that are on queue before you put your own are about 1 million units, and you just put your own 500 units, it will attend to those people according to time first before it will attend to you. That's why the best means is for you to put it at market price. If those people are on queue, if they are more than one, in as much that they put price limit, it will attend to you first before it will attend to them because there's price limit in their transaction. Any other question? Okay, somebody's raising up his hand. You can ask your question, sir.
Good morning, sir.
Okay, sir. Well done, sir.
My name is Adeleke Amos. I want to have the understanding of about the stockbroker that was mentioned the other time. If we have
that's commodity trading, sir.
For commodity trading, I believe the broker is inclusive.
Yes, sir.
Okay. I just want to majorly also I just want to know also about the interface and the dashboard that has been displayed here. I think we can get the website such that we'll be able to have access to some information pending the time, because I'm so expectant to register and then to have to buy in the commodity market. So I just want to get the website so that we'll be able to buy when we have the
Please,
amount
you
of-
do us a favor. Please drop your email on the platform, on the chat platform. Now, somebody will pick it and we communicate with you, and he will put you through on how to register on the commodities trade, as well as, are you a client of Auto Steven already?
I just registered for this webinar, so it's not
Okay, please. It will also give you how to have access to both commodity and aftermarket trading. First and foremost, you have to register. So it's going to give you, please just drop your phone number and your email address immediately after now, so that somebody can pick it and they will communicate with you immediately after this Zoom meeting.
Dropping that, I think an email has been given while I want to log in.
Phone number, okay. Okay, you
Just
can do that,
the
sir.
only the email, not the number.
Okay, you can send the email, sir. That's fine, sir.
All right, sir. True.
Thank you, sir.
How can I send that?
Once we send what you need to use, you know, on the chat, just click on the chat on your trading this thing.
All right, now.
Yes,
I can do that.
Yes,
now.
if you see, look at chat on your platform wherever you are connected now.
Thank you, sir.
If you do not get it, you can call it. Somebody will write it down. The person is online.
But you have no answer about the stockbroker.
Sarah will talk now. Please, Sarah, please, can you answer to that? It's asking about having understanding of the commodity trading.
Sorry, please, can you repeat the question?
I believe stockbroker is inclusive in the commodity trade. Trading, right?
Sarah,
I want to know if that is inclusive, because it was mentioned while Sarah was communicating with us.
Sorry, what was the question exactly? Let me use Michael's laptop. Yes. So the broker is essentially the one that would have the community.
It's essentially
one that we have the community.
All right.
So yes, the stockbroker is the one that has the community, and then you have your clients come under your community. So you sign up as a broker or a broker dealer. There are some requirements that are needed for you to be approved as a broker on the exchange. So once you're able to upload all of those documents and you're accepted, you become a stockbroker on COMEX.
Okay, I became a stockbroker. So it's all right. So with other, I will still get more information. I think I'm clear a little bit on that.
Okay, thank you, sir. Any other question, please? Please, you have not given us your email yet, sir. Your email.
I will do that now.
Okay, thank you. Any other question? Okay, in the absence of questions, I will want to thank everyone for your patience and your time joining this webinar. And I want you to know that this webinar is a monthly occurrence. That is, Auto Steven always hosts a webinar in a month. And we will appreciate if you can join us, whereby we do analysis of capital markets and also on how some of our clients that have an issue with Assam trade can effectively trade on Assam trade. So it's a monthly webinar that we hold every month. And I will appreciate if you can join us next month as well. I would like to invite Sarah or Michael to say something, concluding.
Thank you very much, David. And this is me also saying thank you to every single person who joined the webinar. We hope that it was informative. We hope you learned as much as you could, about the commodities market. So just round off, if you want to know more about the commodities market, you can always go to our website, which is www.afexnigeria.com. And if you want to get started trading commodities, COMEX is available on iOS and it's also available on Android. The minute you download, you'll be giving somebody will essentially reach out to you to just sort of take you through how to get started, trading commodities. So thank you very much, David. Thank you, Arthur Stevens, for having us. We had a wonderful time.
Okay. Thank you once again, Michael. And just like Michael has said, we will be giving you more information on the commodity trading as we are one of the community members. We give you the code that you need to register with them. So we communicate all this to all our clients. And as a matter of fact, if you also want to trade on capital market, if you are new here, you can also log into our website as well, www.autostevenonline.com. You click on sign up to sign in as a first user so that you can open an account with us so that we can quickly open the CSCS account for you. And that will be the next step to your financial freedom. Thank you very much. And thank you everyone for joining us live today. Thank you.